Hello, this is Henry Becker, Director of Research with Lighthouse Wealth Management, and welcome to our halftime report for 2019. So in this quick video, I'm going to talk about where we are with global markets as of June 30th, 2019, and touch on some of the trends and issues we see going into the second half of the year. So let's get right into it, and we'll take a look at a few slides.
So here we are, our first slide. We are taking a look at year to date in the last 12 months for different markets around the world. So we can see the S&P year to date through the end of June up 18.33. The Russell 2000 small cap index right behind it at 16.85. MSCI Europe, basically international index, up 14. Bonds up 5.8. West Texas Intermediate up 28%. Been very volatile, obviously. You can see in the last 12 months down 21, but year to date up 28. Bloomberg Commodity Index, and again, the Lighthouse Blended Index is just something we use to compare a diversified portfolio to some index. So this blended index is made up of large, medium, and small size U.S. companies, commodities, bonds. So year to date, that index is up 11.45. Some of the bigger notable items are actually in the bottom of the chart. Interest rates, we can see the difference between June of 2018 and June of 2019. We're down, we'll call it up 0.5%. 10-year U.S. Treasury yield is actually down, and then the 30-year conventional mortgage is down considerably. Probably wouldn't be the worst idea to look at refinancing if you financed a house in the last couple of years. So if we move on to our next chart, what we see here is the S&P 500 earnings per share. There's a gray bar, a couple gray bars here. Those indicate recessions, and you can see earnings slide off during recessions. But what you can see more than anything, though, is the earnings climbing, the S&P 500 earnings per share climbing. Even though we've seen some dips along the way, this is the earnings per share for the S&P is what's been driving the stock market. Companies have been flush in terms of earnings, and we're expecting that it's probably going to lighten up. A lot of companies are saying that our earnings are going to slow a little bit, but we still think they're going to be in expansion territory, maybe not just as expansionary as they have been. And our next chart, we have the NFIB Index, which is the Small Business National Federation of Independent Businesses, NFIB. And their Small Business Index is basically a survey of like 2,000 small businesses, and they ask them all kinds of questions. But the real point here is that we see the red line. We've seen a bit of a fall off and some volatility in the NFIB index relative to the S&P 500. Small businesses are the lifeblood of the U.S. economy, so we watch this pretty closely. And this rollover we've seen does give us a little bit of caution. In this last chart we have here, the weighted global GDP, annualized growth rate. There's a lot in here, but what I'm going to point to are the primary things to look at is the fall off in the light green portion, which is the other emerging markets. Other emerging markets would be countries other than Brazil, Russia, India, China, and South Africa. So that would be places like Argentina and Taiwan and Colombia and so forth. So some of your smaller emerging market countries, they've fallen off quite a bit. And we've seen a good drawdown in developed markets, which is the blue section right here. And that's more or less the US, and a lot of Europe have really contracted. So what you can see, if we look back in other recessionary periods of the chart, which would be right here and right here, this is the dot-com bust, this is the 2008 crisis, you can see breaching the 3% growth rate for the global economy has, in the last, we'll call it in the last 20 years, has been an indication of perhaps recession looming. But we can see we've tickled that territory a few times without a recession. So Not saying that there's a cause or an effect here, just pointing out the fact that the global economy has been slowing down.
So what's ahead? Actually, before we get to what's ahead, let's answer a question that you might have in your head, which is, how on earth is the market, U.S. market and global market, doing so well, considering that we appear to be having a slowdown? From the charts we just looked at, global economy, U.S. economy is slowing down. Well, the answer to your question is the Federal Reserve. The Federal Reserve has made it clear that they are open to lowering interest rates to help boost the economy. Now, we all know after 2008, the Fed took interest rates to zero, held them there for 10 years. In the last 2 years, they've been gradually increasing rates, and that gradual increase in rates has been to give themselves room should we see the economy start to slide. They can lower interest rates again to boost the economy. So right now, most of the big Wall Street banks, Goldman Sachs, JP Morgan, and so forth, they are supposing or guessing that the Fed is going to lower interest rates anywhere from 0.25% to 0.5% at the later half, or not later half, but at the end of July when the Federal Open Market Committee from the Federal Reserve meets again. So the one thing we've learned in the last 10 years is you don't fight the Fed. If they're going to lower interest rates and try to bolster the economy, there's a good chance they're going to be able to do it. And if that's the case, it's going to be good for the stock markets. So we could definitely see an extension of the rally that we've seen since the beginning of this year. Now, in terms of rate of change, market's up quite a bit so far through the first half of the year. I don't know that we're going to see a doubling of that, but there's a good chance we can maintain, if not add a little bit to it, if the Fed steps in and does lower interest rates, which would definitely be favorable for the economy and the markets. So now, understandably, we have global tensions with Iran, with China and the trade war and so forth, but that just appears to be noise at this point. What the market's calling for is a lowering of interest rates. So that's where we are for through the first half of the year and what we're looking at going into the second half. As always, if you have any questions, issues, or concerns, please feel free to reach out and give us a shout. Thanks, and have a good second half of the year.